Hello there again, this is forexbrokers.net, and this is the third video part of the double combinations article, part of our training academy. In the first one, we laid down the rules, or the theoretical rules for a double combination. In the second one, in the second part, these are the theoretical rules, how it looks in reality, the common one. In the second part, we explained the double combination, the lower time frames, a very complicated one, but this is a real shape or a real double combination that appears on the markets, on financial markets, on the currency market especially. An even more complex one is this one. Focus here, this is still the Euro US dollar recent price action. Don't focus on the right side here, but focus on the gray area here. This is nothing but a double combination. If we follow the same steps and principles explained in the article and on the previous two videos, it becomes obvious that this is a double combination because wave A is followed by a price action that fails to retrace more than 61.8 of it. The market makes a new low. The price action that follows fails to fully retrace the new segment or the C wave in less or the same time it took for the C wave to form. This means that this ABC is not a simple correction, but is actually a complex correction. At this point in time, the logical process tells us that a complex correction has either a small X wave or a large X wave. So the next step is to take a Fibonacci ratio from here, or Fibonacci retracement ratio, to measure this entire A, B, C out of this degree and find out the 61.8 level. If we have a market move beyond the 61.8, the market forms a complex correction with a large X wave, a double three, a triple three, a double three combination, and so on. If the X wave or the market moves like this and fails to retrace beyond 61.8, the chances are that we will see either a double or a triple combination. If the legs to follow looks corrective, then the chances are the market forms a double combination. Also, coupled with the fact that statistically double combinations are much more common than triple combinations, then the first thing to test is to apply the rules of a double combination on the market. So the market forms an X wave. Why the X wave not here? Because if we take the 0 to X, as we explained the channeling earlier, there is no channeling at this point. Not that it will make a difference from the overall pattern. Imagine that you will have the X wave here. It doesn't change anything. The double combination still ends at the end of the triangle. But what's interesting here and difficult to assess is not the X wave and the channeling component, but the triangle at the end of a double combination. In this theoretical example, the triangle is obvious. A, B, C, D, E. But in reality, all the legs of a contracting triangle are corrective waves as well. And contracting triangles at the end of double combinations are non-limiting triangles. Non-limiting triangles, they are defined by a non-limited price action to follow after the triangle is broken. And more importantly, a non-limiting triangle often forms a triangle on its own for the E wave of that triangle at the end of the double combination. So for this E wave, if you go on the lower time frames, you will find most likely a triangle. On a lower time frame, for this double combination, for that E wave, most likely the market forms a triangle. A, B of a lower degree. Not labeled here, but you can imagine one. A, B, C, D, E. The market breaks the B to D trend line, consolidates, retests the B to D trend line, and then pushes forward to the upside. It implies that the double combination ends here. And then, depending on the shape of the A, B, C, D, E, where the apex go, you will find out if the double combination is a fully retraceable one or not. In other words, by the time that the market ended this triangle here, does it have the power to fully retrace the entire double combination? I mean, it started here from the end of wave A out of this degree. Well, with the current move that we just saw, incidentally, today, the double combination was fully reversed, and the Elliott Waves trader already knew that based on the shape of this double combination, and especially the shape of this triangle. Double combinations, once again, are complex corrective forms that have two simple corrections. The first one not confirmed by the X wave, not confirmed by the price action. So these two simple corrections are connected by an intervening wave, the X wave. The X wave on its own is a complex correction. Rarely it is a running pattern. In other words, it must end into the territory of the previous ABC. Don't be fooled by the price action, as it can fool anyone. Here, did the X wave end into the territory of this ABC? Yes, because if you take a horizontal line and mark the end of the X wave, you see that the end of this C wave is here, and the X wave ends into that territory. So this is the X wave. A complex horizontal correction, probably a very complex correction with a large X wave. If you have the chance to go to the Trading Academy and find out the difference between complex corrections with large X waves and complex corrections with small X wave. This X wave is likely a corrective wave, a complex correction with a large X wave. All in all, remember this: double combinations form often on the currency market. They cannot start with a triangle. They end almost always with a triangle. And depending on the triangle's shape, we know if the double combination is fully reversible or not. Thank you for being here, and bye-bye.